Hello, everyone. Welcome along to today's information session for the Algorithmic Trading Certificate, the ATC. My name's Jeff Brown, and I've been involved in professional qualifications such as this one for many years, for over 2 decades, such as the CFA, the FRM, the CQF, KIA, MLI, QDC, and so on. And what I would like to emphasize is that, in fact, of all the programs that we run at WBS Training, not only all the programs that we run, but also all the programs that I've been involved with over the years, the ATC for me is one of the most extraordinary programs. And the reason for that is because it has to be a technical program for sure. It's algo trading, but it is incredibly applied as well. And for me, it sits right up there. It's almost in a league of its own. I'm hoping that in this information session, which is really the purpose of this, is to give you a flavor, a strong feel for what this is about. And Nick Ferruzzi and Brian Healy are the 2 lead lecturers on this program, the 2 lead faculty, if you like, on this program. And for me, it's primarily down to them that they're able to combine very eloquently teaching quantitative, technical concepts in very simplistic terms, whilst also helping you to implement what you're learning so that you can become a really good algo trader. That's what this course is all about. And I'm hoping that during this session, I'm sure during this session, you'll get a strong flavor, not only of their style and how eloquent they are in explaining what this program is about, but also just a strong idea of what you will end up with after 3 months of a pretty intense course. So who are Nick and Brian? They're extremely experienced. Like me, they're going a little bit grey, at least Nick is in any case, which is a good sign, I think. And Nick is working at TradeLink Holdings. They're a prop trading and investment management firm. He's got a very senior position at that firm. He's held all sorts of senior positions for lots of different organizations over many years, including senior directorial positions at the likes of, including incidentally, managing director roles, executive director roles at Goldman Sachs, at Nomura, Citadel, Deutsche Bank. He's also taught he's lectured at the University of Illinois, at the Courant Institute of Mathematical Sciences, at UCL, and as an expert in algo trading, I don't think we can find a better person. And again, during this presentation, you'll see what I mean. He's extremely eloquent. And then, of course, we also have Brian. And Brian, equally, they've worked together for a long time. They know each other very well. They've designed this program together. And Brian has worked at, again, many different organizations. He's got senior advisory roles. He's a fellow and chartered statistician, I should say, at the Royal Statistical Society, an associate member and chartered mathematician at the Institute of Mathematics, Data, AI, and ML Thought Leadership Group at Thilesians. These are some of the positions he's held. Industry sector expert, AI and finance expert, fintech investment portfolio. He's worked at a number of different organizations. In fact, he's got very senior roles in various different organizations. He's the CEO at Decision Science, and they are all about building algorithms and data models using very complex analysis, statistical modeling, and mathematical principles. And this is to help businesses driving their commercial success, essentially. Chief Science Officer at Stoic, which is a next-gen portfolio management firm. He also advises a number of asset managers as a consultant on quant strategies, including alpha generation, dynamic allocation, and risk management. He's a managing partner at Barclay Generation. This is all he is doing this. Okay, this is current. He's got lots of different roles at Decision Science as well. He's Chief Scientific Officer, Head of Quantitative Modeling. He's also worked for various different banks in the industry, including Barclays and Citigroup and so on. So look, they are the right people for this job. I know that algo trading is a particularly challenging subject to teach, and I think you're in good hands. So I'll stop right there. I'll stop my blabbering, and I'll hand you over to the inimitable Brian Healy and Nick Ferruzzi.
Thank you, Jeff.
Thanks, Jeff. I'll share the deck for a moment. Just to stop us wandering off too much off topic. Okay. Can you see that, Nick?
Yep. Yeah.
Super. Okay.
Okay.
So I guess you.
Shall I start?
You start with the introduction, Nick, and I guess we can skip who we are. I think Jeff has covered that very eloquently.
Yep, that's right. So yeah, so just our course, Algorithmic Trading, a Practitioner's Guide. It was started after I'd say many years, and I'm unfortunately I'm going around backwards here. We both Brian and I have been teaching. So I started out this course back in 2016 at UCL, some version of it, and it's been online and a master's course at UCL. Now with over some 600 students have taken it, both the online and the master's version. Brian as well has been teaching a number of courses at UCL, and which are extremely pertinent, and much of that same material has been combined, we thought, in a much more practical manner for this specific course. So just to start out, algorithmic trading is a broad term which relies on mathematical models for trading, which relies on mathematical models and algorithms. You'll find out there's a rather broad umbrella for a sector within the finance industry. So as markets have become more automated, an increasingly large volume of trades are executed using algorithms, either e-trading or oftentimes high frequency trading. But the high frequency traders are facing the mid frequency traders. So there's just a tremendous amount going on. Many exchanges are now dominated by high frequency market makers, with increased volume and speed leading to higher returns. So algorithms can be used for all aspects of the business, and we want to sort of highlight the entirety of the algorithmic trading business. So it goes from high frequency to mid frequency to low frequency in trade decisions, in portfolio allocations, and in trading execution and placing orders. Some quant funds were heavily algorithmic from the start, while others deploy algorithms as one element of their approach. And some shops automate the entire process, some only automate parts. So it depends really on the products. So who and why? I guess this is probably about us. Oh yeah, who is this course for?
Oh, here's it for, yeah.
Yeah. So the course is for, and what we found is that there are quite a lot of discretionary traders who've taken this course before. We've had risk managers as well. And it helps to understand the mechanics of the market and develop tools to devise and manage new and improved algo strategies. It learns about the pros and cons of different approaches to allocation, execution, and performance testing. It's also for algorithmic traders themselves. Many algorithmic traders don't necessarily they trade without necessarily having an understanding of the underlying principles. So meanwhile, many quants come from outside algorithmic trading and want to know about why it works. And so what we offer is to appreciate when commonly used strategies work and when they don't, and understand statistical properties of strategies, expanding the toolkit. This course is also for graduates, students, and data scientists to gain familiarity with algorithmic trading strategies and master the underlying theory and mechanics of common strategies. So it's you're supposed to be able to engage with academic research into a large number of the open questions in this area, because it's really a broad and dynamic area that continues to evolve.
So I guess we can really skip this.
Yeah. What I guess one thing that Jeff didn't point out, I started at Lehman, and so that's that's one badge of honor there. Of course, Brian and I met at Deutsche Bank many years ago.
Yes. So it's all Deutsche Bank's fault, as many things are.
Yeah.
So the goals of the course then are to, well, first of all, really to provide a foundation or a kind of a basic education really in what algorithmic trading is and the sort of tools that you need to work in the industry. You learn a lot about data sources, so where data comes from, how to clean it, etc., and where to look for alpha, where people traditionally look for alpha, and where people look for alpha now, and how that's maybe evolved. And then most importantly, I guess, really for anybody doing the course is, given all of the above, how do you actually test the strategy and then optimize it, including its execution? As Jeff mentioned, the real kind of aim of this course is to be as hands-on as possible. So throughout there will be an emphasis on implementation, on execution. This is what Nick and I do every day, and the course culminates in a large project where you have to actually create and implement an algorithmic trading strategy. But by then you will have all the tools to do so, and that will hopefully be allow you to even if your that effort is not your finest hour in a sense, it will get you well on the road to building efficient, scalable models. Do you want to do why this course, Nick?
So say this is a fully revised version of the course Algorithm, the trading strategies. I've taught it at UCL to computational finance and risk management, PhD and MSc students. I started in 2016 with just PhD students and faculty members, and then it was clear it could be developed into a master's course, which I subsequently did, and been offered to over 600 students. Completed earlier versions, as well as I've offered it as well online, different versions of it. So I found that the many found the material very useful for their subsequent work in industry, and many people who are in industry have gone on to use it as well. So the course takes a hands-on approach to building trading pipelines, from data to features to modeling to allocation, execution, performance, and risk measurement. And what we should expect by the end is that anyone who takes this course should be able to, well, is required to be able to build a trading strategy and to test and show appropriate performance, and to describe in great detail a lot about it. Not necessarily to give away the I made a mistake here. This is the 5th cohort of the for the ATC with this improved material.
So do you want to do the odd weeks
Sure.
and I'll do the even weeks?
Sure. Okay. So the syllabus, there's quite a lot of detail in this, and we might go a little bit quickly through
Yeah.
it, because we could drone on forever. But the first week is basically is relatively lighter. It's an introduction and industry overview. and talking about the types of trading, what different types of algo trading there are, what types of trading strategies, and introduction to what the field is. We also talk about the industry, what the structure is, the different subcategories, from high frequency to mid frequency to the factor allocators, and the size and growth, as well as different approaches. Some simplified frameworks, whether full-on approaches, different execution styles, and then finally looking at a trading platform architecture for this.
Then in week 2, we begin with the all important data. So where, the sort of data sources that are typically used in algorithmic trading. So we tend to use a lot of things like futures, etc., and where they come from, and how you can get them. So there's issues then around how you roll them, how you store them in a database, how you make them accessible, usable, and so on. Things like naming conventions. A lot of the kind of the gotchas that people spend a lot of their time actually, buried in this sort of detail. And then we look at some of the specific stuff around particular asset classes like, commodities, equities, because they each have their own idiosyncrasies, they each have their own jargons, their own exchanges, and so on. Fixed income, again, is a lot of it's not traded on exchanges. So what are the issues there with over the counter, etc. And we touch on, we sort of put in place some of the basic ideas that you will need as we go on in further weeks to discuss the individual strategies. Throughout, but particularly, I guess, at this stage, we do introduce those sort of light reading as well. And we have a long list of books that we've read, that we would recommend maybe for certain things, some broader than others, some more specific than others, and at different levels too, so that we make that available as well. And then there's this whole idea of extracting features from data. So anybody who's done any kind of statistics or machine learning will be familiar with this, where you start off with your raw data, and then from that you've got to extract essentially information and eventually signals and trades. But along the way you need to create features, and there's things like outlier detection and data imputation where you've got missing data. So there's all of these kind of, I would call them almost boring but important things that if you don't get them right, the rest of it, implementing an algorithmic trading strategy just won't work. So they're they're very important. And then we touch on some of the sort of signals that we'll be extracting from this.
Then in week 3, we sort of, I guess you'd say, back up a little bit to give some of the background material that's necessary. And so the initially on statistics, specifically time series statistics. So, sort of what is, the basis of statistics, whether it's definitions of densities and distributions, expected value, mean, variance, skewness, all these sorts of statistical measures, with the motivation of looking at asset prices and asset returns and how they work through time, because they're very specific. We go into stylized facts about asset returns because, unfortunately, a lot of just regular statistics doesn't really fit them exactly. So statistics gives very great answers to questions you don't necessarily ask. I guess we worry about, as they say, the sort of the basics of financial time series, whether it's future value and compound interest and discounting and things of that nature. And then we go on to what is probability. And this we could spend way too long on, but we don't, of course, because we have to move on and motivate it. And types of distributions, whether they're uniform, Gaussian, log normal, students t, how you fit them, how you infer them, and not just how you simulate them. And the whole concept of maximum likelihood estimation, which is very important. And that's the primary motivation behind a lot of our statistical inference methods. Then we go on to multivariate distributions, which are so bivariate, multivariate, independent, looking at independent random variables, covariance, correlation, and multivariate normal distributions. And then on to the hows of statistical inference. We talked about maximum likelihood, but why does it work? Central limit theorem, confidence intervals for means, hypothesis testing, and non-parametric tests on distributions. And then finally on to time series, which is what we're really focused on. So what sort of time series are you interested in? We're first of all, we're interested in looking at things like, ARMA and ARIMA models, but we want to look at things like whether they're stationary or not. And so we do stationarity tests, we do trend models, integrated models, and give lots of examples of those. Then we move on to mean and general framework for mean and autocovariance, looking at stationarity in general, looking at white noise, lags, and differencing. So I think this is leading to ARMA, so autoregressive processes. AR1 and the general ARP process, ARP models and stationarity, which ones are stationary, which ones aren't, and then moving average models, and how you can transform one into another, identifying P and Q in an ARMA PQ, using PACF and ACF, and other different ways for doing model estimation. Finally, looking at differencing so we can move forward to ARIMA models, full ARIMA models, exponentially weighted moving average processes. So EWMAs are really simplified versions of ARIMA models, and they've been used for much, much longer. And then again, touching back on maximum likelihood estimation. I think this actually follows a bit more the flow of the slides, but maximum likelihood estimation for the ARMA model and for the general ARMA PQ. In the end, we touch on the history of forecasting and how there are three separate methods for forecasting that are typically used. There were exponentially weighted models, which are surprisingly effective. There's ARMA models, and then there's Kalman filters. And it turns out there's a tremendous amount of overlap between them and many ways of tying them together. So it's a little bit of a 6 of one, half dozen of another. It's important to know the entirety of the landscape.
So then in week 4, we look at machine learning, which is, clearly a huge topic in itself. And, I even teach a full semester course on it at UCL. But here, what we're really trying to do is just sort of give the absolute basics so that you understand really how it fits into the sort of algorithmic trading landscape and how that's evolved. Because obviously, this is very much a current evolving space. So in order to make that possible, we have to do some of the intro to machine learning as quickly as we can. So we quickly look at things like supervised, unsupervised learning, classification, and regression. So some of the basic ideas behind machine learning models. Then we look at things such as support vector machines, which is a bit of a mouthful, but is actually one of the more common machine learning methods, which is very powerful and actually motivates things called kernels, which are, it can seem quite mathematical, but are actually very useful for building strategies. So a surprising amount can be done with this relatively simple idea. Then we look at things like decision trees, which are kind of important almost for two reasons. Number one, in and of themselves, because they're an important class of models, but actually also a lot of algorithmic trading strategies actually look a bit like decision trees, where you have maybe a different regime. If volatility is high versus volatility is low, you have like almost like branches in your strategy. So there's a conceptual thing there that's actually very useful too. Random forests are a more evolved version of decision trees, an ensemble model, and again, there's lots of different models in machine learning which combine more simple models. So that gives us an opportunity to explore some of them. And then neural networks, which most of you have probably heard of. We give you as much as you need to kind of understand where they could be useful in this particular space. And then finally, reinforcement learning, which has been used quite successfully and fairly I would say widely, but quite a lot, I think, in algorithmic trading. It's been a well-trodden path almost at this stage. It seems to work quite well with time series. So we give you the background to Markov decision process and how these systems learn as they go along. That's the whole idea behind them, is that they learn through essentially practice through trading. They kind of figure out how best to allocate capital. And then week 5, Nick.
Oops, sorry. Okay, week 5, we move on to specific to trading strategies. How do we define a trading strategies? What is a self-financing trading strategies? How does it work in theory, but also in practice? And then some example strategies, including, okay, first is just as a benchmark, buy and hold. But then we move on to trend following and trend. So a couple different types of strategies. Trend following specifically because it's a very important strategy. It's one that underpins a large portion of the algo trading industry. And how do we define momentum? The various different definitions of momentum, and sometimes they're the pros and cons, and actually more or less equivalence between them. The fact there's 200 years of algo trade of momentum, and can you skip back, Brian?
Oh, sorry. Yeah.
200 years of trend following. It's been successful for that long a period. So it's a very fundamental type of strategy. And we look at some of the properties of it. The fact that momentum is one of the few strategies that's positively skewed. Most everything in the world is negatively skewed, but momentum is positively skewed, and that's a very attractive property for investors, for hedge funds, for anyone who's trading it for that matter. And then we look at various different definitions of momentum and how the trade-offs that they incur, whether in terms of responsiveness versus drag, versus their theta. And then another very important concept is cross-sectional momentum, which is what's used primarily in the equities factor allocation. So it's different from time series momentum. It's not just buying it if it goes up and selling if it goes down. It's buying the winners and selling the losers, and that's really an important way of that equities factor allocation is done. And those people there, it also permeates through places like statistical arbitrage and things like that. So other topics in momentum, we talk about the fact that almost every financial time series mean reverts over a very short horizon, trends over a medium horizon, and then over an extremely long horizon will mean revert once again. So momentum is something that's, the questions about it being overutilized. There are funds that are moving into less liquid assets, finding every possible asset to trade that trends. And then finally, we move on to trading futures. How can you set things up? This is a bit of a specific asset class, a very important asset class, and one of the sort of the historically truly important ones for algo trading. How do you gather information on the futures market? How do you find the research that you need? How do you develop, securities tables, rolling their futures, all the different naming conventions, and then updating your futures data, just as a way of keeping things in track so you can actually trade the futures.
Then in week 6, we go to a different class or category of algo trade or strategy, which is carry and volatility. I guess there's 2 here really, but they're quite related. And we begin really by motivating carry in the foreign exchange market, where in a sense it began and where it's perhaps a bit more obvious and easy to explain. And it's also still a huge trade, as was evidenced last year when there were problems with a large unwind in these trades. So we look at things like the FX forward market, the spot market, how interest rate parity works, and how they how you set up a carry trade basically, and why it works when it does work, and why it doesn't work when it doesn't work. So we look at some of the history, so how it's worked historically and how it continues to work. We look at some of the major drawdowns, some of the major periods where it did very, very badly, and we then look at carry more broadly in things like swaps, futures, and other markets, because it actually can be applied in a wide variety of markets. We then touch on something that's a little bit more kind of academic, but it's important certainly for anything involving options. The idea of different risk measures. So we generally operate in our everyday lives in what's called the P measure, the physical measure, the probability of X, Y, or Z happening tomorrow. But actually, a lot of things like derivatives in general are priced using what's called a Q measure, which is this risk neutral measure. And so we just to really just touch on it again enough of that to sort of make what follows sensible, because we need this in order to explain different risk premia that are observed in the market. And a lot of volatility strategies involve trying to capture these risk premia. Then we get into things like the mechanics of margin, which are particularly important with derivatives in general, futures, but actually increasingly with other asset classes where margining is more common now than it used to be. A lot of exchange traded products, but also particularly with options. So whenever you're dealing with options, you essentially got a lot of leverage and a lot of kind of margining involved. We run through some of the more common volatility strategies. So there are 2 or 3 kind of main headline types. And then having sort of looked at the pros and cons and how each of those are implemented and different regimes in which they work, we look at volatility regimes in general and how volatility can and has been modeled. Because that's one very important aspect of all this is what is volatility? What are you actually trading? And then in week 7, Nick?
Week 7, we move on to mean reversion, sort of the opposite of trend. And specifically at mean reversion and stationarity. And so of course, we have to go into what is this, how do we do stationarity tests? There's several of them. The augmented Dickey-Fuller is one that most people will have heard of, but then there are things like the sort of very closely related Hurst exponent and variance ratio tests, which are I'd say very closely tied to the performance of mean reverting strategies. We look at, and then I guess sort of the question, why bother with statistical tests? In fact, they actually do help. There are a lot of great mean reverting strategies out there, some of which you can, regular traders can take advantage of, many of which are a little bit challenging because of the speed of reversion. One thing that's always possible, even on lower frequencies, looking into co-integration. And what is co-integration and why does it matter? How do we use stationarity tests to establish co-integration, and what do we use it for? So we look at implementing mean reverting strategies. We give an example of a mean reverting strategy, and then look at the how mean reversion is basically the same thing as liquidity provision. That mean reversion, the returns on mean reversion is a measure of liquidity provision risk, liquidity risk premium. Reversal strategies do well in volatile markets and illiquid markets, and it's very highly correlated to market impact. So mean reversion is effectively what high frequency trading shops are all in the process of doing for the most part. Then we look into change point detection, because mean reverting strategies, in order to make them work, you have to know when not to make them work, when to get out, because oftentimes things that mean revert will stop mean reverting. So then we look at some of the more standard. I mean, everyone probably has an idea about regime switching or regime detection. In practice, it turns out that for the purposes of forecasting, many change point detection models tend to work slightly better, and they're slightly more robust. So then we look at some of the pros and cons of each. Finally, we look at pairs trading. Actually, not finally, but so we apply co-integration to pairs trading, and statistical arbitrage as well, because it fits very well in there, and in RV in general. Then we look at factor models in PCA. So the factor model, what is PCA, how you do a linear factor model. It's actually it's very closely related to co-integration, but a slightly different twist on things.
So in week 8, we kind of look at something a bit more general in a sense, a bit broader again. We go back to features, forecasts, and our features, factors, and forecasts, where we really just build up a picture of the sort of signals that we look for. So we've seen some of those with the different strategies that we've just discussed in the past few weeks. So how do we kind of combine these, sort of begin to think about how these would actually go together? I guess is really what we're aiming for here. So, factor trading has by this point been discussed a few times, but we look particularly at, things like CAPM, the arbitrage pricing theory, which is sort of a broader factor model. And these things are still actively used in all firms, particularly those who are trading equities. And we look at how there's so many new abnormalities that are allegedly found all the time and are published in journals. This is called this factor zoo. What we how how essentially do we deal with that? How much of that is actually kind of noise and how much is actually relevant to us, and how to actually be able to read. Because I think one very important thing from this course is to be able to read research to some degree, so you can actually read a paper on a strategy and spot where they've cut corners or where they haven't necessarily done a very good job or where the results aren't very robust. So a lot of that will be covered here in that, we sort of go into significance, powers, and so on. Now, dimension reduction is, this whole idea of, particularly when you have, something like an implied volatility surface or even a yield curve in fixed income, and you've got, many tens, hundreds of different bonds, thousands of bonds, lots of different points in a yield curve. How do you actually collapse those down to something more manageable using a robust mathematical method? So we look at some of those approaches here. And then regularization is something that's really, I think, applied nearly to every model, sort of, nowadays, where we, particularly, now we use more and more machine learning with a lot more data, how we actually kind of apply these methods on top to kind of make decisions on model selection and so on. Double descent is something that Nick in particular has done a lot of research on, where it turns out that when you massively overfit a model, which in the past would have been seen as a very bad thing to do, is increasingly seen as something that actually can be more benign than that. And in fact, you get this. You can actually get to a point where the model begins to improve again, which is sort of contrary to what people thought. Adaptive filters and other Kalman filters and so on. So again, this was touched on earlier in the time series section, but again, we come back here to sort of look at how these are used mainly in the forecasting space, right? So how do you actually use these for forecasting, prediction, etc. And forecasting versus allocation. So let's assume you could forecast with a certain degree of accuracy what's going to happen next. Well, what portfolio should you have, right? What's the actual allocation you should have? That's not always as simple as it might seem. So you've got things like loss functions, mean squared error, etc. How do we measure a good model versus a bad model, and how do we penalize models for getting things wrong, etc. And week 9, Nick.
So week 9, we move on to market microstructure. And this is very important to know about when it comes to execution and transaction costs. So how are markets defined? There are 2 major types of markets. They're quote-driven markets and order-driven markets. The quote-driven markets being, the ones that you have to do an RFQ, request for quote. And those are typically OTC markets. Whereas in order and quote-driven markets as well, sometimes they have streaming quotes. whereas an order-driven market is something like an exchange, and they have a central order book typically. And so there are different types of market types, and price discovery is quite different in each of them. And so we look into how the underlying markets matter when it comes to how we design our algorithms. Then what's called, so I don't really like the word here, what's traditionally called algorithmic trading, and there are books sometimes on it, is really specifically e-trading. So what is this? What is this e-trading or high frequency trading? The different types of agency algorithms, proprietary algorithms, the different how it works at sort of automating the trading process and trying to reduce trading costs. We already discussed this to some extent, but when it comes to markets that are order driven, the different types of orders, whether they're market orders or limit orders, and how and there are other types of orders as well. How those orders impact your trade, your trade cost. And then it's specifically looking at market impact. What is market impact? How can you measure it over different horizons? What's the difference between TWAP and VWAP when it comes to execution? And how do you optimize your market impact? So various different Almgren, Chris, for instance, optimal liquidation method, looking at the difference between permanent and temporary market impact, and as a way of as either minimizing the impact or minimizing the risk. And then finally, we look at, I think this is the last section here, is market making. In an order book, what's the impact of a new order, the different dynamics, and how can you come up with how can you find an appropriate optimal bid-ask spread? Where should you place your market given the dynamics of the market itself? And that's a Hohenstall model. There are a couple other models for that sort of give a theoretical foundation for that.
In week 10, then we look at, the fairly, I guess, obvious culmination of a lot of what we've talked about in the first 9 weeks, which is portfolios, right? So what should my portfolio be, or what should my allocation be across asset classes, within asset classes, given, whatever signals I found, whatever combination of signals, whatever combination of strategies, etc. And so again, we can review a little bit of this sort of CAP-MAPT kind of framework and their extensions, the French model. And also we look at, well, what is an optimal portfolio? How do you define optimal? What's optimal for different types of entities, be it a pension fund or an insurance company or a hedge fund, and so on. We discussed things like Sharpe ratio, most of you have heard of, but there are other information ratios we look at as well. We look at minimum variance portfolios, mean variance optimization, and touch a little bit on things like utility, which are important in this context too. Then we kind of, harking back a little bit to the execution stuff we discussed, we say, well, how should I allocate given transaction costs? Because what you don't want to do is keep chopping and changing too much, right? Rebalancing your portfolio too frequently, because that will incur transaction costs. So that must be factored in as well. And there are ways of doing these optimizations with Lagrange multipliers, quadratic programming, and how you actually implement that in code with examples. Tactical asset allocation is, again, a bit more reactive. Okay, so it's a lot of the same ideas, but done. We look at it specifically at mean variance optimization in the form of a regression. And week 11, Nick.
And then week 11, we look at sort of the multiplicity of performance indicators. How do you measure the performance of a strategy? And I'd like to say that there's okay, everyone knows about Sharpe ratios, but there are many others. There's Kalmar, Omega, Sortino, tail ratios. There's so many other sorts of ways of looking at it, and I'd say each of them has their own shortcomings. But irrespective, in order to go into more detail, especially about the Kalmar ratio, we have to look in some analysis at drawdowns. How do we analyze them? How do we create plots out of them? What's the max drawdown? What's the max drawdown length? Those sorts of things, statistics that comes to the performance of your strategy. And then we have quite a lot of example code for that in particular. We look at returns, how you annualize them, how you analyze the Sharpe ratio, value at risk, and how you manage to compare the different performance indicators. I'd say oftentimes people aren't satisfied with just one. Then we work on a back test. What is a back test? What's a viable back test? How should you go about back testing? Whether it's, when it comes to trading decisions and settlement, and the financing that goes into this. It varies product to product, but sometimes it's slightly more complicated than others. We look at leverage and how to get sort of the maximum out of your portfolio. Whether it's margin, initial and maintenance margin, all the different types of limits that one can put on a portfolio, whether they're gross, net, or even just say capital constraints. I have a certain amount of margin I can put up, and that's it. We look at whether you measure your performance using specific P&L reinvestment, or just that you have a fixed amount of capital. And then we look at how do you record the back test? How do you save this, because it's a very important experiment. Finally, we look at things like optimizing hyperparameters. Every one of these strategies has a lot of hyperparameters in it. Whether it's the look back period of your moving averages, whether it's the number of features in your model, how often you re-update your model. And so there's many different common methods for optimizing your hyperparameters, or for tuning your algos. Sometimes it's by hand, but oftentimes you don't even know where to begin in terms of the where in parameter space you should be looking. So we look at various different common software that explores the hyperparameter space in more detail, giving a better sense of where you should be, fine tuning.
And finally, in week 12, we look at risk management, which always seems to bring up the rear in these things, but it is of central importance to making your business, your trading business, work without, and it should be considered as part of the strategy development process. It's very much integral to everything we do, but we start by looking at some of the terminology and the different risks that you encounter in a portfolio, and depending on what products you've got in there, etc., and what sort of horizons you're looking at. We touch briefly on operational risk because it's very important, and it's where a lot of funds in particular and financial institutions really have failed. It's because of operational risk rather than market risk, which is where most of the emphasis tends to be put. The risk management framework is, again, I'm going to use that phrase, boring but important again, but it's really important to have a governance in place, like, it's limits, a way of controlling the risk. And that really leads to, once you put that in place at a high level, then beneath that you can fill in things like, well, what leverage am I going to use? What's scaling for my strategies? So how should I decide on the sizes of my position? And there's things like the Kelly criteria, which some of you may have heard of, which is quite an aggressive strategy. But again, there are others which we look at. Then we talk about how you implement stop losses and what can go wrong, model risk, software risk, etc. And then value at risk, which most of you I'm sure have heard of, but it's still used, so and it is still useful. But it's very important to know what its shortcomings are, and there is an expected shortfall and others which we also look at, and we get into a little bit of extreme value theory just to talk about how these kind of real tail risk events can be viewed mathematically. And factor models come up here again because really all of these risks are, in a sense, factors. So you can just bucket them all under that kind of model structure. And your covariance matrix is going to be one of the most important things if you're dealing with lots of different assets. So how you estimate covariance, how you, and how you evolve it over time, how you update it daily, weekly, however you do it. So the next section is that's it for the syllabus. We just want to talk briefly about the prerequisites, I guess. So what you need to make the most of this course, really, and also the all important assessment. So do you want to talk about the prerequisites, Nick?
Sure. So the prerequisites, we're going to expect either intermediate or experienced programmer, preferably with working knowledge of Python. And though Python is not used throughout the industry, the fact is it's a real standard for when it comes to sort of conveying information and talking about algorithms. So everything we do is in Python. We also expect some knowledge of statistics or econometrics or machine learning. They're almost all, they're all based on the same thing. We'll assume sort of, familiarity with it. We do cover some of the basics again, but it's a relatively fast paced. So it's, as a consequence, more of a review than anything else. Also, basic finance or familiarity with economics. We assume that basic knowledge of financial markets, what they are, and a basic understanding of things like utility theory from economics. And then a plus is some familiarity with SDE and differential equations. Although they're not fundamental to most algo trading, sometimes little toy models come up specifically in them. Of course, they're absolutely fundamental when it comes to vol trading.
And then the assessment is at the end, and it will be a sort of PDF and Python notebook, or another language if you really prefer, describing a strategy in detail. So from start to finish, what the strategy is, how you implemented it, the rationale, the back testing, all of the performance measurements, etc., and also the limitations, room for improvement that you have identified, and what you would do next, etc. And we will give marks be given for all sorts of things. Obviously the how well you've explained all of the above is really important. So even if you come up with sort of great results, let's say, it's not just about that. It is also about how you did you go through the process. Obviously we all like great results, but to be honest, even if you don't have great results, if you've gone through the process and documented it and explained, you can still get effectively full marks. This is not purely about coming up with an amazing strategy. If you do, obviously we can go into business together and we'll all be very happy. But that's not the primary purpose.
So
And
just to sort of
yep.
fill in for that, we've had students who've given just amazing uh, final reports, and it's not that they had amazing strategies, but they went into great detail, sort of the exploration of why they came up with a strategy, how they came up with a strategy, how it performed, and including things like room for improvement, because that's a very important thing to have knowledge about where the shortcomings are, because every strategy has shortcomings. Every quant is always working on improving things as time goes on.
So to wrap up then, Nick, do you want to take this one?
Sure. So algorithm trading is a large and growing part of financial markets, and is especially with machine learning algos, it's only going to become more relevant over time. We all know that's moving in that direction. As an area of study, this is new, and there's very few university courses in this area. I think the one at UCL is one of the first. So, but hopefully this is a ongoing move going forward. And oftentimes, but the ones that do focus on it are often focusing only on pure mathematical aspects, and they neglect the analysis of what risks to take and why and how much to take of it. And that's what this course gives you is how you go evaluating risks and opportunities. So Algorithmic Trading, a Practitioner's Guide is aimed to give you the practical skills for getting started in this area.
Right. And the all important questions and answers. I guess the questions are going to come from you guys, and the answers hopefully from us. Don't be shy. Anybody got any?
Yeah, thank you. I'm a little bit concerned about how fast-paced that can be in 12 weeks' time. I find that it's a lot of information, and it will be good to have a little bit more of insight as to what level of knowledge should we have. Like I know you say intermediate, say for example in Python, intermediate or advanced, that's fine. It's a programming language, but in the levels of statistics and stochastics, a basic level or a working basic level is enough, or does it have to be very advanced?
I'm gonna say we tend not to. Okay. Although there's a lot of concepts that we consider we're not the most what would you say, not the most careful statisticians, right? So not everything has to be perfect. Not, it's sort of a working knowledge more than anything else is what, and so, if you know a regression, you know what Gaussian random variables are, okay, there's not a whole lot that involve Poisson processes or anything like that, but there's Gaussians, sometimes looking at how their fat tails and things aren't quite Gaussian, but I think there's some background knowledge in central limit theorem and why things tend to work. And then there are some of the machinery of regressions. What are standard errors? What's significant? What's not? Just as a way of building models. The goal is building models. And I know that this emphasis here on statistics, you could say it's not very modern because a lot of people are really moving forward with machine learning. But I'd say machine learning is, and AI is, the basis for it is statistics. And even though I would say that in algorithmic trading, the vast majority of what is done is either trading technicals, trading financial models, or just plain old regressions. And there's increasing amount of work in the use of AI, but the penetration in the entire industry is relatively limited as of yet. And so that's something we go into in some detail is, what we do know of, what's going on and what's working. But again, I'd say that there's a lot of it is based on just pure, computational statistics.
Thank you. So I have three more questions, but I'm gonna fire them out to see if you can combine them into one. So would you recommend any pre-work before engaging in the course, any books or any readings that covers those econometrics, statistics? It can be different books. The other question would be, does this would help the retail trader, or is it only focused on like enterprise or corporate as a career professional? And the third question I already forgot. Sorry.
Okay.
It's all right.
Yeah, so we have had retail traders join us,
Yep.
and specifically because they, many people, they're either, we've had day traders join us, and some are familiar with some basic statistical approaches, some are familiar with maybe using technicals, but as long as they're, we're somewhat agnostic. As long as it's repeatable, you can test it. Now, so it is something that is it. Our course is meant for all different types of traders, not just. And I think there's maybe slightly more focus on futures, many of which are certainly accessible to retail traders. So either futures or ETFs, which are again relatively easy to trade. that tends to be our primary focus. We do talk about some fixed income, but that's I'd say it's there. Unfortunately, there's an so I specialize in fixed income, and there's an awful lot of machinery that's involved in fixed income, so that it's just it makes it impenetrable. So I don't think it's really worth focusing on. There's again we tend to focus on slightly more accessible markets. Books, that's actually a really good question. But you're looking for books specifically in statistics or time series analysis.
Well, it would be the books that will help more with the course, with the content of the course. So if it's time series analysis, then I'm looking for an answer of like, yeah, you should focus on if you already have the basics of statistics, then you should focus on a time series analysis level of statistics, and maybe focus that statistic book in Python, for example, so that
Right.
is interchangeable with the knowledge of the course.
So the unfortunate thing is a lot of time series analysis books are written by econometricians, and a lot of econometricians will say they want to do it in Stata or in R
Mm,
or in some even worse languages that you
yeah.
know. So actually, maybe if you could, Andres, if you could drop your email to Jeff, we can get back to you about that, because we do have a list of books, but it's more like how should you build out your algo trading bookshelf rather than what specific background materials are really good to look into. And
Yeah.
I know a few on that list that are more appropriate than others, but it's something we have to think about.
Yeah.
Yeah, thank you. I appreciate that. But it's something that I think if you're investing 12 weeks with fast-paced knowledge, you need to be prepared. It's not like you're jumping in the course and then you're like, oh, I need to revise this and it will take me 4 hours, and you don't really have the 4 hours to review that. So I prefer, for example, my personal experience, I prefer to wait and say, all right, the next cohort in June, for example, it's not that it's in June, but it's only an example for the audience,
Yeah.
and then I take these 4 months to prepare on that. And I remember now what's the next question before I
Right.
forget again, is what's the level of effort on a weekly basis average? I understand that everyone will have a different level of effort, but it would be good to understand, look, at least you need 20 hours, something like that.
So 20 hours, I'm going to say that's too much. I hope it's too much. I don't think we've tortured people that much. But certainly the in-class time is around 3 to 4 hours per week. I'm including the possibility if you wanted to go to both we typically have two live sessions, one morning UK time, which is accessible to Asian clients, and one around this time UK time, which is accessible to North American clients. Or students, sorry. But probably around 2 hours of lectures, I think.
Can I add to that, Nick?
Yeah.
This is something you're right, Andres, in that this is variable according to each individual, and according to each week as well. The times vary, but generally speaking, what I would say is you only ever do a program once, right? Whether it's a 3-month or a 6-month program or a university degree, you never repeat the program. So my advice to people coming through these kind of programs is, most of the people doing these programs work full time, is maximize the opportunity if you do decide to enroll onto this program. So in a way, sacrifice a little bit of whatever time you normally have, even if it's, work commitments, family commitments, whatever free time you can find, try to use that time to study towards this program, because that way, by the end of the 3 months, first of all, you won't have regrets about not quite having done enough, and do I have enough knowledge to be able to master this, these techniques. If by the end of the 3 months you've really gone for it, then you'll have made the most out of it. And I know that doesn't sort of numerically answer your question, but hopefully it gives you an idea. The more you put into it, the more of your own time you put into it to try and implement some of the methods that are being discussed, the more knowledge you'll have by the end, and your skill set will be really good by the end.
Excellent, thank you.
Pleasure.
No, I mean, there are people with a range of skills that have taken it in the past. But that's for you to judge your own. And I think it's important to know it's not to be taken lightly. It's a big commitment. Yeah. Any other questions?
I should mention actually that if any of you are, members of GARP or Premier or CQF holders or CFA holders, we do have discounts for those qualifications. So just send me an email, because they vary according to each qualification. And similarly, we've got some regional discounts as well, not many, but the ones where it's really needed, where it's really necessary. So just send me an email, and I'll let you know what the discount is. The standard fee, incidentally, is £3,950. I do believe at the moment there is a discount available. I believe it's 10%, and I'll just check that now. And I'll also let you know what date that discount runs out. So there's a discount, right. Okay, there's a 10% discount until the 14th of February, which is tomorrow. I think, look, if you've attended this session, what we'll do is we'll extend that by a week. Okay, so if you want to enroll and you would like to enroll with a 10% discount in place, then for those of you who've attended this session, we'll extend that by a week till next Friday, which is a week and a day, actually.
Sorry, could I ask my reflection on this? I looked at the. Are you able to hear me?
Yes.
Yep.
Yeah. So on this, I looked at the content. It's obviously a mix of financial engineering, I would say, or parts of it definitely, econometrics. If you're doing SDE and option pricing, or you want to understand all the rest of it, you need to understand, or at least review your differential equation and understanding P versus Q measure. And then you go on to obviously modern things like machine learning, you added into this. And obviously this course, I suspect, is a lot more practical than a master's in financial engineering. And you have packed it in the 12 weeks. To me, I've done a master's in financial engineering, and I still kind of, wouldn't say that I fully grasped it properly, to be honest. To do this whole thing in 12 weeks, either it's too high level, or I don't know. Means how do it means? My reflection is a lot of material really in 12 weeks.
Okay, so I'm going to say that some of what you say is probably not so much an emphasis. That although we talk about P versus Q, it's not really an emphasis. It's more a justification for the there are people with financial. There's so many quants out there who only know risk neutral pricing, and that's all they know. And this is a very different world here, where statistics matters and option pricing tends not to. So there is some portion of the course that it's a very small portion. It's just on vol strategies. And for that, there's option pricing that's necessary. And it's typically looking at things like short gamma strategies, and some of the Greeks that are involved in defining the performance of options. But for the most part, I'd say for a lot of people with there are people with financial engineering backgrounds who are increasingly doing machine learning and statistics, but many people do not. And so this is the primary focus here is really machine learning, statistics, econometrics, and sort of the tidbits of finance that you need in order to make it work. So the asset pricing models, we don't justify CAPM and APT, but we use them. Why is there a beta? Why is there a market? What does it matter? Why, how did Fama and French come up with their portfolios? How are those factors important, and what are some other factors? And what you'll see is that a lot of these things are sort of basically like regressions. Although economists love to justify them as equilibrium models, that's just more of that's their justification. I'd say as equilibrium models, they don't necessarily work that well as sort of a justification for adding a feature into a model and doing a regression or doing a machine learning algorithm based on that. They work great. So I guess we also do give a lot of materials, like background materials, reference materials, because we don't want people to sort of stop learning. Because I think it's really important here is this area is actually it's a growing field, and there's lots and lots of interesting things that come out often in this area. And I think that's kind of one of the important things is we want to show you our enthusiasm for this area and to give you as much material as possible for you to continue your studies in these areas. The other thing that we do is we have it's sort of still work in progress, but we're working on a way of keeping in contact with all former students through sort of a separate part of the WBS training hub, where there will be a wiki with all the materials, as well as all the materials that we've only talked about that weren't even discussed in the matter of the lecture notes, but were talked about in our online classes, and sort of growing from there.
Yeah, this is quite interesting because obviously, you take all this information, a lot of this, you just don't have enough time during the day to obviously go through the whole stuff, understand it really to the core.
Yeah,
Because as a financial engineer, you don't want to just superficially understand something. You
right.
do want to go into the basics, absolutely, and that would definitely take time. And
Yeah,
the ability to come back to it with the tutor in future or somebody who knows is quite valuable, I would say.
yeah, and I think so. I mean, we've never thought of old students as being, someone with strings attached, because, people don't stay in contact nearly enough. So I think it's a very sensible thing, that there's because your learning process should continue. And I think that's a very important thing, to stay in contact to whatever extent possible.
And I think the other thing is that, yeah, if you've got questions afterwards, then you know, as an organization, as a training organization, we're extremely supportive of that. So any questions you have, you know, there was somebody I remember from EIB who did one of our programs, you know, another very technical program, and needed to do a project at work that related to the knowledge that she had acquired from this program. And this was about a year later. And she came through and came through to us, and we gave her a lot of advice, ongoing advice. And she came through with an amazing project at work, which was deemed incredibly successful, to the point where there were decisions at the IB that had been taken as a result of this project. So we try to help. That's really what training organizations should be about. Try to increase the knowledge of those who are paying for that knowledge. So it's not just 3 months, you know, it is ongoing. And if further down the line you need our help, we'll provide it to you.
But it's also important how much of it you're really going to use in your work. Means unless you are an algo trader yourself or you're on the trading desk, at least you would probably never use it, to be honest. I mean, for me, like in the market risk area, very limited of all this is obviously useful. Occasionally, yes, it is good to know and good to be able to discuss and understand. But unless you really use it, it just gets lost, to be honest.
But I think on that one, Nihal, if that's how you feel, honestly, don't do it. This information session is to determine whether the program is suitable or not for you. And if it's not suitable for you, don't do it. But if you feel that you will get something out of it, if you feel that it can be beneficial, then do it. Simple as that. So we're not forcing you to do anything. This is literally just, here's the information about the course, and now you make your decision.
Yeah, it's my just reflection.
Yeah.
Nothing more than that.
Actually, Nehal, I mean, I know, I guess it depends. We've had people who were quants who, you know, actually oftentimes most everyone's involved is relatively more senior. But we've had quants who were in adjacent areas, who were very interested in it, some thinking of making a move, and some actually actively pursuing it. In risk management, I guess it depends, because there's for some risk managers, it's an important subcategory of the things they have to look into. But it's but yeah, it really depends. It really depends.
Yeah, it's good to know, definitely, but not necessary. Not necessary. Yeah, this is how I will.
I mean, I suppose, I mean, I guess if you're, you know, I know, so I know risk managers at large investment banks, and they do have e-traders who are part of the overall risk that they have to monitor. You know, there's some elements of it are potentially useful for them.
Yeah, I do agree with you on that. And that's the reason why I'm interested and I'm looking at this whole thing. Yeah. But what I'm saying is I meant something else. To be able to really get everything out of the course, you got to be in the front of the trading desk and apply everything unless, you know, otherwise you're not going to. You're going to be a step behind, definitely. Monitoring somebody else's risk taking.
Yeah.
Is it a question then, Nick, that you know, is this something that also that, you know, Nihal could do in his spare time to practice, if you like, and maybe at a certain point when getting more expertise in it, be able to transition to a more relevant role?
So we also know people, of course, who've maybe they're quants, but they want to, they like the idea of trading on their own.
Yeah.
Maybe it's not, so for retail trading, oftentimes, it's possible to use the underlying knowledge and apply it, I don't know, in crypto, in futures trading, and other sorts of things, and to really, find things that one's satisfied with. That's also so we've seen that. I'm not just saying that's it's the right goal for everyone, but we've certainly seen people who that's one of their interests.
These are valid, very extremely valid questions. In any case, these are really pertinent. Have we got any other questions for Nick and Brian, or any questions? It doesn't have to be about the content of the program. It can be about anything at all to do with the algorithmic trading certificate. Okay, so I think if any questions pop up, which often happens in the coming days and weeks, although obviously not beyond the start of the program, then get in touch and we'll do what we can to answer your questions. And again, I'll just put my email address and my phone number. You can reach me on WhatsApp if you prefer. And that way, if any questions do pop up, which you hadn't thought about during this particular session, then feel free to give me a call or send me an email, and we can arrange to have a chat as well. And I hope this has been really useful. Nick, Brian, thanks a lot. This was really clear.
Thank you all.
And
Thank you.
Look forward to speaking to you all soon. All the best. Take care.
Thanks. Bye-bye.
Thanks.
Bye-bye.
Bye-bye.